As we focus on those two numbers, we need to be aware that the profits figure has its quirks. Profits in 1998 included one very unusual item: a $16 billion bookkeeping gain that Ford reported from its spin-off of associates, and profits also included, as they always do in the 500, the earnings of a few mutual companies, such as State Farm, that do not have a market value. Additionally, one major corporate expense, stock option compensation costs, is not deducted from profits. On the other hand, the profits figure has been reduced in some cases by write-offs that probably didn't reflect economic reality and could just as well be added back in. But leaving aside these qualifications, investors were saying on March 15 this year that they would pay a hefty $10 trillion for the $334 billion in profits. Bear in mind, this is a critical fact often ignored, that investors as a whole cannot get anything out of their businesses except what the businesses earn. Sure, you and I can sell each other stocks at higher and higher prices. Let's say the Fortune 500 was just one business, and that the people in this room each owned a piece of it. In that case, we could sit here and sell each other pieces at ever-ascending prices. You personally might outsmart the next fellow by buying low and selling high. But no money would leave the game when that happened. You'd simply take out what you put in. Meanwhile, the experience of the group wouldn't have been affected a whit, because its fate would still be tied to profits. The absolute most that the owners of a business, in aggregate, can get out of it in the end between now and Judgment Day is what that business earns over time. And there's still another major qualification to be considered. If you and I were trading pieces of our business in this room, we could escape transactional costs, because there would be no brokers around to take a bite out of every trade we made. But in the real world, investors have a habit of wanting to change shares, or of at least getting advice as to whether they should, and that costs money, big money. The expenses they bear, I call them frictional costs, are for a wide range of items. There's the market maker's spread, and commissions, and sales loads, and 12b1 fees, and management fees, and custodial fees, and wrap fees, and even subscriptions to financial publications. And don't brush these expenses off as irrelevancies. If you were evaluating a piece of investment real estate, would you not deduct management costs in figuring your return? Yes, of course, and in exactly the same way, stock market investors who are figuring their returns must face up to the frictional costs they bear. And what do they come to? My estimate is that investors in American stocks pay out well over $100 billion a year, say $130 billion, to move around on those chairs, or to buy advice as to whether they should. Perhaps $100 billion of that relates to the Fortune 500. In other words, investors are dissipating almost a third of everything that the Fortune 500 is earning for them, that $334 billion in 1998, by handing it over to various types of chair changing and chair advisory helpers. And when that handoff is completed, the investors who own the 500 are reaping less than a $250 billion return on their $10 trillion investment. In my view, that's slim pickings. Perhaps by now you're mentally quarreling with my estimate that $100 billion flows to those helpers. How do they charge thee? Let me count the ways. Start with transaction costs, including commissions the market makers take, and the spread on underwritten offerings. With double counting stripped out, there will this year be at least 350 billion shares of stock traded in the US, and I would estimate that the transaction cost per share for each side, that is, for both the buyer and the seller, will average 6 cents. That adds up to $42 billion. Move on to the additional costs. Hefty charges for little guys who have wrap accounts, management fees for big guys, and, looming very large, a raft of expenses for the holders of domestic equity mutual funds. These funds now have assets of about $3.5 trillion, and you have to conclude that the annual cost of these to their investors, counting management fees, sales loads, 12b1 fees, general operating costs, runs to at least 1%, or $35 billion.